Latest tax scam warning from the IRS. The Internal Revenue Service devised a taxpayer campaign known as the Dirty Dozen campaign that is directed at warning taxpayers of the most common tax scams that are being perpetrated in the United States of America. As part of this Dirty Dozen campaign, the IRS recently sought to warn wealthy individuals with respect to 3 tax traps targeted at wealthy taxpayers by dishonest promoters and shady tax practitioners. For those with high incomes, there is a temptation to seek out various tax planning schemes and aggressive tax strategies with the aim of reducing taxes. And while there are legitimate means to reduce the incidence of taxation, there are identified schemes that run contrary to the Internal Revenue Code and the court's interpretation of law, which can make these schemes illegal, including 1. Inflated art donation deductions, 2. Aggressive charitable remainder annuity trusts, and 3. Detailed shelters that maneuver to delay paying gains on property. As IRS Commissioner Danny Werfel stated, quote, high-income taxpayers can be vulnerable to being pulled into these aggressive schemes and scams, end quote. As such, quote, taxpayers should be extra careful on tax maneuvers that seem too good to be true. Beware of advertisements for seemingly ideal tax structures that distort tax laws and leave victims with civil or criminal tax penalties, end quote. Werfel added, quote, there is growing risk for taxpayers pulled into aggressive schemes as the IRS continues to accelerate and expand our compliance work involving high-income individuals, end quote. End quote. The IRS reminds taxpayers that relying on an independent tax or legal professional can help avoid problems with aggressive promoters, end quote. The 3 tax scams that the Internal Revenue Service highlighted were, with the specific wording of the Internal Revenue Service being particularly important to understand both the tax issue and part of the position that the IRS is taking in relation to the particular issue. 1. Improper art donation deductions. There are ways for taxpayers to properly claim donations of art, but some unscrupulous promoters use direct solicitation to promise values of art that are too good to be true. These promoters encourage taxpayers to buy various types of art, often at a, quote, discounted, end quote, price. This price may include additional services from the promoter, such as storage, shipping, and arranging the appraisal and donation of the art. The promoter promises the art is worth significantly more than the purchase price. These schemes are designed to encourage purchasers to donate the art after waiting at least 1 year and to claim a tax deduction for an inflated fair market value, which is substantially more than they paid for the artwork. Promoters may suggest taxpayers donate art annually, allow them to buy a quantity of art that guarantees a specific deductible amount. Promoters may even arrange for certain charities to take the donations. The IRS has a team of professionally trained appraisers in art appraisal services who provide assistance and advice to the IRS and taxpayers on valuation questions in connection with personal property and works of art. Quote, creativity in art is a beautiful thing, but aggressive creativity in art donation deductions can paint a bad picture for people pulled into these schemes, Werfel, end quote, Werfel said. Quote, this is another example where people should be careful when it comes to aggressive marketing and promotions. There are legitimate ways to claim an art donation, but taxpayers should be careful to understand the rules and watch out for inflated values or questionable appraisals. Beauty is not always in the eye of the beholder when it comes to tax deductions of art, end quote. 2. Charitable remainder annuity trusts. Charitable remainder annuity trusts are irrevocable trusts that let persons donate assets to charity and draw annual income for life or for a specific time period. The IRS examines charitable remainder annuity trusts to ensure they correctly report trust income and distributions to beneficiaries, file required tax documents, and follow applicable laws and rules. A charitable remainder annuity trust pays a specific dollar amount each year. Unfortunately, these trusts are sometimes misused to eliminate capital gain. Here's how it works. The appreciated property is transferred to a charitable remainder annuity trust. Taxpayers wrongly claim the transfer of the appreciated assets to the charitable remainder annuity trust, which gives those assets a step up in basis to fair market value as if they had sold them to the trust. The charitable remainder annuity trust then sells the property but does not recognize gain due to the claim's step up in basis. The charitable remainder annuity trust then uses the proceeds to purchase a single premium immediate annuity. The beneficiary then reports as income only a small portion of the annuity received from the single premium immediate annuity. Through a misapplication of the law relating to charitable remainder annuity trusts, the beneficiary treats the remaining payment as an excluded portion, representing a return of investment for which no tax is due. Taxpayers who seek to achieve this inaccurate result do so by misapplying the rules. 3. Monetize installment sales. In these frequently shady deals, promoters will look for taxpayers seeking to defer the recognition of gain upon the sale of appreciated property and then organize an abusive shelter through selling them monetized installment sales. These transactions occur when an intermediary purchases appreciated property from a seller in exchange for an installment note, which typically provides for payment of interest only, with principal being paid at the end of the term. In these arrangements, the seller gets the lion's share of the proceeds but improperly delays the gain recognition on the appreciated property until the final payment of the installment note, often slated for many years later. Taxpayers need to realize that these highlights are merely scratching the surface as to these particular tax scams and how the IRS views them. The legitimacy of any tax strategy needs to be appropriately assessed with knowledgeable tax counsel, who is prepared to share with the taxpayer the legitimate concerns and issues with any particular tax strategy. Even with legitimate tax strategies, one slight alteration or a change in the factual elements can transform a legitimate tax strategy into an illegitimate tax dodge, such that tax professionals need to be cautioning their clients as to these concerns. And the tax professionals that you consult with should be independent of the tax promoters that are pushing and promoting these particular tax strategies, with independent tax lawyers and tax accountants providing you with their professional assessment of these promoted tax strategies. Optimizing and maximizing tax strategies all too often means getting to the border between legitimate and illegitimate tax approaches and staying on side, such that a tax strategy that attempts to get the most out of structuring with the Internal Revenue Code is going to be on the verge of entering the realm of illegality, such that it needs to avoid crossing that line. Always be cautious with respect to any tax strategy, as the legal and financial repercussions of engaging in an illegitimate tax scam can be quite severe, especially where there are knowledgeable independent tax professionals capable of keeping your activities legitimate. Thank you.